Prime Minister approves 10-year tax reform strategy. State Bank of Vietnam buys $1 billion as of last weekend. Inflation seen from Vietnam Annual Economic Report. Thank you for watching the Daily Biz on VTV4. My name is Peter DeFreitas, and those were the headlines. Stocks on the Ho Chi Minh Stock Exchange have plummeted across the board, widening the losing streak to 7 days and keeping the market benchmark VN Index at a 6-month low for another day. This as investors continue selling off shares to seek safer shelter on speculation that the downturn was not over. The VN Index dropped 11.98 points or 2.69% to end at 432.87 points, the lowest close since November 24, 2010. Stocks on the Hanoi Stock Exchange plunged to its lowest level since February 2009. The HNX Index dropped 1.26 points to end at 76.98 points. The Upcom Index, the measure of 126 unlisted public companies, extended its losing run. The index lost 0.13 points to close at 33.94 points. The market volume totaled 83,200 shares, valued at around 814 million Vietnam dong. Now let's take a look at today's gainers and losers. Prime Minister Nguyen Tan Dung has approved a 10-year tax reform strategy for 2011 through 2020 in order to meet the needs of the market economy while enhancing revenue sources, increasing production capacity, and sharpening the competitiveness of domestic enterprises. The comprehensive strategy encompassed reforms to the value-added tax, personal and corporate income taxes, special consumption taxes, import-export taxes, environmental taxes, and fees and duties on mineral and land use rights and agricultural lands. Under the plan, tax revenues would be increased by 70% by 2015 and 80% by 2020. By 2015, the state budget would be equal to about 23 to 24% of gross domestic product. After the first bustling 2 months of the year, the steel market has become quiet since the end of March with very low demand, even though it is now the high season for construction.
The steel prices have dropped by 200,000 to 400,000 dong per ton, now selling at 15.6 to 16.2 million dong per ton with deliveries at steel mills. According to the Vietnam Steel Association VSA, though the first quarter of the year was the low construction season, the demand for structural steel increased abnormally by 40 to 50% in comparison with the same period of 2010. The prices have been decreasing since the beginning of the second quarter due to the low demand. Explaining this, VSA said that the ingot steel in the world market recently tends to decrease. Meanwhile, domestic steel mills have to lower the sale prices in order to make their products competitive to the imports from China and Southeast Asia. Particularly, the demand for steel has been decreasingly sharply due to the sharp cuts of public investments. A lot of construction projects funded by the state or local budgets have been postponed or delayed as part of the plan to fight inflation.
The Ho Chi Minh City municipal government has closely controlled its budgetary spending for basic construction investment and focused capital on transitional projects. In the initial phase, the city checked the usage and withdrawal of advanced capital of ground clearance compensation units with total advance and transfer capital of 308 billion dong. The city also proposed to cut capital of 453.2 billion dong in 95 projects, including suspending 15 projects with cuts amounting to 37.9 billion dong, extending the progress of 80 projects. The Ho Chi Minh City Department of Planning and Investing is checking the progress of projects to consider capital transfer for transitional projects that could be finished in 2011. Vietnam's General Department of Customs has reported that 21,406 foreign-made cars worth $392 million were imported in the country during the first 4 months of the year, which is an increase of 63% in volume and 72% in value on year. In April alone, 5,546 cars were imported worth $113 million, a slight decrease of 2 to 3% in volume compared to the previous month, yet an increase of 58% in volume and 85% in value compared to the same period last year. Recently, the Ministry of Industry and Trade issued Circular Number 20 to ask Vietnamese businesses to obtain import licenses for purchasing small cars less than 9-seaters. They also need to maintain documents to prove that they are genuine distributors. The circular will be in effect as of June 26. According to car importers, most car showrooms do not comply with regulations. Now let's take a look at the foreign exchange rates updates as of May 20th. According to the online newspaper Toi Bao Kinh Tế Saigon, the State Bank of Vietnam, or SBV, has brought in $1 billion as of last weekend due to the dollar exchange rates dropping to a 3-month low, and it has also been reported that it will continue to buy further.
The central bank's move will increase dong liquidity in the banking system. Therefore, the SBV is expected to take action to moderate dong supply in an effort to achieve the inflation battling goal. Either of the following 2 measures can be taken: raising reserve requirements or issuing government bonds with high yields. Raising reserve requirements would help to boost up lending interest rates at banks, the Thời báo Kinh tế Saigon pointed out, yet maintaining concern as to whether the Ministry of Finance will raise government bond yields. The volume of compulsory bond issues can be 20 trillion Vietnam dong, equivalent to $1 billion, which the SBV bought in, the local media reported, noting that this solution is practical and suitable with current market conditions. Last week, the dollar bid was quoted at 20,610 Vietnam dong per dollar at local lenders and 20,600 Vietnam dong per dollar at the SBV's foreign exchange office, after remaining stable at 20,700 Vietnam dong for many weeks.
A number of domestic businesses are likely to follow the example of the Hoang Anh Gia Lê Group, HAG, in issuing international bonds to quell the thirst for capital.
The national industrial giant on May 11 launched $90 million worth of international bonds, which are due to be listed on the Singapore Stock Exchange, offering an annual interest rate of 9.875% for a 5-year term of reimbursement. It is part of HAG's plan to raise $200 million from international bonds, making it the first private domestic business to launch its bonds to international markets. Vietnam Coal and Mineral Group, Vinacomin, is expected to follow suit with its proposal to issue international bonds worth $500 million, which is now on the table for government consideration and approval. Vietnam Oil and Gas Group and Vietnam Electricity Group are prepared for a similar action, which values up to billions of dollars. Despite awareness of the numerous risks ahead, many international financial institutions express optimism towards Vietnam international bonds. HSBC, for example, said Vietnam's international bonds are expected to bring in more profits this year than those from other Asian countries due to its government's sound policy on inflation control.
In 2010, in Vietnam, there were up to 345 merger and acquisition, also known as M&A deals, announced with a total transaction value of up to $1.7 billion. But according to market researchers, 2011 will be the time of flourishing a series of large M&A deals. In recent years, M&A activities in Vietnam continue to grow and become one of the most notable investment channels of domestic and foreign enterprises. According to the statistics presented by PricewaterhouseCoopers Research Division at the 2010 M&A Vietnam Forum, in Vietnam there were up to 345 M&A deals being announced with a total transaction value of up to $1.7 billion, up 65% in value compared to 2009. This is the highest M&A transactions value the Vietnam market has ever had in years. The Vietnam Center for Economic and Policy Research, VEPR, an independent research center under the University of Economics and Business, has recently released the Vietnam Annual Economic Report 2011. In this report, inflation remains a major topic.
The price of electricity so far has increased more than 15%, and that of petrol has also doubled. Prices of a wide range of commodities such as coal, cement, and fertilizers have also climbed. The thing is that prices of essential goods are pushed to sudden increase. This causes big influences to production costs and consumers, and thus the inflation this year is really high. The government has tightened financial and monetary policies to control inflation. However, this action is causing difficulties to enterprises to approach production capital. I think that monetary policies shouldn't be too tightened. They should be more flexible and should be done at the right time. Otherwise, they will negatively affect production activities of enterprises. The worst scenario is that inflation would continue to go up till the end of the year. In addition, the economic growth would go down due to the state bank's decision to increase interest rates, which would not have yet made an immediate impact on businesses. In this context, with a high amount of investment poured into production, businesses, especially those working in the financial and banking areas, would face heavy losses or even bankruptcy. We have introduced many policies, but they are just temporary. We do need long-term popular policies. If the inflation happens again, we won't have to sacrifice our growth to stabilize the economy. The inflation of the first 4 months is nearly 10%, which has surpassed the level allowed by the National Assembly by 3%. As expected, with drastic measure of the government, the inflation will gradually recede in the coming months. Focus on controlling inflation will affect the growth rate, but many accept this. Once the inflation is controlled, the macroeconomy will become stable and growth will return.
The New York-based Seeking Alpha website on May 18th posted an article saying that there are many opportunities to invest in Vietnam. The website noted that GDP growth has remained relatively robust over the years. The 2008 commodity bull market spurred a similar course of events, but even with the global recession, annual GDP growth didn't take too much of a hit. Vietnam's GDP growth is forecast at around 5 to 7%. Seeking Alpha also highlighted Vietnam's strength of cheap labor. It said Vietnam is adding 1 million workers a year, which is good for cheap labor and a competitive advantage line. China exports big volumes of products to Vietnam every year, but it is also a vast consumption market. Vietnamese enterprises have been urged to find out the ways to boost exports to China. China needs Vietnam's rubber, cassava, and coffee. According to the Ministry of Industry and Trade, there are at least 5 categories of products China needs to import from Vietnam, including farm produce, high-grade wooden furniture, seafood, processed food, and consumer goods. Vietnamese rubber has become famous in China in the last 20 years. Especially, China now buys tires made in Vietnam instead of importing rubber to make tires domestically. This should be seen as a big opportunity for Vietnam to boost exports to the market. You have been watching the Daily Biz on VTV4. My name is Peter DeFreitas, and thank you for watching.